If the previous RSI episode was a meaty T-bone steak drenched in béarnaise sauce and with a pint of milk on the side, then this one is a vinaigrette salad with a glass of water. Let's now further clarify the techniques we've learned with some examples and wrap up the RSI book for now. In this episode, we will go through more examples of how to use the RSI. If things don't make sense, I strongly recommend you to re-watch the previous episodes in which we discuss in detail everything you need to know about the RSI and how to properly use it. We will also repeat and expand on where to enter trades, where to put your stop losses, and how to fully put theory into practice. We will do so by going through some examples. And at the end, we will also discuss scenarios in which these techniques don't work. For they don't always work, not even close. For let's be realistic. If these techniques were to always work, trading would be much too easy. But the amazing thing is this: it works often enough and with remarkable precision. Identify an equity once in which it works and it is yours to milk forever. For knowing when to sell at a distribution phase and buy in an accumulation phase over and over offer an impossible to beat trading advantage.
Buy low, sell high, that's my motto. I may just quit my job at the power plant and become a full-time stock market guy.
Here is the German DAX index on the weekly chart. The settings are as follow: the lower bearish blue, 30. The lower bullish red, 38.50. The upper bearish blue, 61, the upper bullish red, 75, and the green line, 50. Always 50. And as we talked about in the previous episode, the red and blue lines are based on the most frequently occurring and matching historical local price and RSI highs and lows, or common local key reversals, to put it differently. Now, the German index is literally cluttered with buy and short signals. It has continuously let us in early on whenever a distribution phase were to shift to a markdown and whenever an accumulation phase were to change to a markup. Dating all the way back to the summer of 1989 and to the summer of 1990, the RSI made a gradual yet steady decline upon which it eventually touched the upper bearish blue at 1950, after which it rolled over and died. This entry spot was less than a mere 1% away from the, up to that point, all-time high of 1,966. It bottomed out at 1328 for a maximum of 32% multiplied by your leverage. In October and December 1992, we got accumulational buy signals from two clean lower bullish red touches that did not break below it. These purchases were triggered at 1489 and 1476 respectively. From mid-1993 to March 1995, we had a long RSI decline. We later see that this entire unfolding of price movements was a big bull flag. What about the January 1994 upper bearish blue touch then, you might ask? Compare it to the 1990 unfolding, which had a dynamic RSI decline, one that had actually hovered around more steadily and clearly below the upper bearish blue prior to testing it. In the 1994 case, on the other hand, it was just a quick one-day closing dip below and then a retest, which is rather noise than anything else. Down and up in just 2 days, literally. Had the RSI stayed below for another couple of days, at least prior to testing the upper bearish blue, it would have been a completely different story. As prices proceeded in the major markup, the RSI declined steadily throughout 1997, but without ever giving us a clear touch for a sell or short signal. Instead, it was just another power amassing pause before proceeding higher. The next sell or short we were given in May 2000 at 75.30. After that, neither the price nor the RSI recovered above that very point. In August 2004, we were given a buy signal upon the clear and dynamic lower bullish red touch at 36.47, which again was neither broken below by the RSI nor by the actual price. On Christmas Eve of 2007, after another steady and gradual RSI decline, we were given a clear touch of the upper bearish blue and again spookingly close of the all-time high. This time at 80.67, whereof the all-time high was at 80.92, just 0.3% off. This markdown was followed by another buy signal in November 2011, upon which the RSI made a clear touch on the lower bullish red. Again a level which neither the price nor the RSI broke below, this time at 54.92. Today the German DAX is trading at around 12,600. If we were to have followed the system and bought and shorted whenever there were clear touches on the upper bearish blue, again touches from below, not from above, and in a distribution channel, or clear touches from above on the lower bullish red after the RSI had made gradual declines in distribution phases or gradual increases in accumulation phases, our results would look like this. And do note that all those numbers are based on closing prices. So, distribution, July 16, 1990, short at 1989. Accumulation, December 7, 1992, buy at 1489 and 1476. Distribution, May the 1st, 2000, short at 75.30. Accumulation, August 9th, 2004, buy at 36.47. Distribution, Christmas Eve 2007, short at 80.67. Accumulation, June 27, 2011, buy at 54.92. Before calculating the compounded return, we need to see what the slippage would have been, as in buying or shorting opportunities that were stopped out. Having gone through the chart multiple times, I can only find one such occasion in May 2015 upon which we took a short at the second bounce at 11,815. The price did decline quickly after that, and in practice we would have made a good profit from partial sell-off targets, but sticking to only shorting the top and buying the bottom, we would in this case have been stopped out at a break-even in January 2017. We would not have bought a clean lower bullish red touch in March 2018 for the simple reason that it's not an accumulation phase. Far from it. Personally, I like to trade the upper bearish blue and lower bullish red lines even when they are not in an accumulation or distribution phase, as they tend to offer remarkably good risk-to-reward trades for minor swings. The only difference is that I take profits much quicker. Now, without any leverage whatsoever, this would have granted us a compounded return of 6,560%, or 65x. Add some leverage to that and you of course end up with a completely different story. This might sound ludicrous, but don't forget that this single example stretches over 30 years, which in itself would be equivalent to just short of a 15% annual return. And had you bought and held from the initial accumulation phase of 1992, you would still have made a solid 760% return on its own. The only difference in this case is that you would have managed to dodge every crash and plummet and buy back before every major upside. This is what's called trend following and is what many of the most successful hedge funds do, albeit not necessarily from using the RSI alone, but from other techniques and strategies. Now, when we look at full market cycles, we primarily use the weekly chart in order to distinguish early warning signs of markdowns or markup phases to come. The weekly chart is by far the most reliable for full market cycles, and anything else should only be used in discretionary exceptions. But we can also look for local market cycles, as in shorter ones, cycles within a bigger cycle. For that, our prime focus is rather the daily chart. And the good thing about this is that you will automatically have access to much more data and pivot levels. These episodes take a lot of time to make, and if you like what I do and want to see more episodes, please like and subscribe. Now, to clarify what we mean by local, a normal market cycle, such as the ones between each crash or recession, can contain several smaller market cycles. In late 2011, we had a local accumulation phase which was then followed by a 3-year-long markup. The index then entered a local distribution phase. Again, you can clearly see how the RSI steadily declines, in this case even creating an obvious RSI divergence. As thoroughly stressed in the previous episode, the main things to look for when distinguishing a markdown to come are 1. A steadily declining RSI that has a hard time breaking above the upper bearish blue. This is the first warning sign of exhaustion and of bearish times to follow. And 2. For a clear retest of the upper bearish blue which is not taken out, at least not immediately. Do note that both point 1 and 2 need to be ticked in order for it to be a signal. It is just not enough with a mere declining RSI from strong levels. It needs the upper bearish blue touch too, and neither will a simple upper bearish blue touch suffice on its own. Now, on April 7, we got a sell or short signal. This one was quickly stopped out a week later as both the RSI closed above the upper bearish blue as well as the price closing 0.77% higher than the entry point. But soon enough, we got ourselves a new short entry point, this time on April 27th at the very local high of 1720, which was also the absolute all-time high of the entire local market cycle. The very day after, the price rolled over and eventually bottomed out at 1240 for a minus 28% decline. We even got a second entry spot again on August 10, 2015, upon which the price again rolled over and plummeted the very upcoming day. The same happened again on December 2nd. We were then given a final shot on May 30th, 2016 for another 10% plummet in just 2 weeks, and again taking that short at its very local high. All in all, we were given no less than 3 shorting entry opportunities, all at the very respective local highs. As discussed in the previous episodes, the touches don't necessarily need to be exact, but quite often they in fact are. For if you have a hard time distinguishing whether the RSI touches the RSI lines or not with the naked eye, it is most certainly good enough for a position. On June 2nd, 2000, we got a clear sell or short signal on the Swedish OMXS30. It was halfway through the distribution channel when the RSI, after having steadily declined from continuously high levels and down to having a hard time passing the upper bearish blue line, that we in fact got a clear touch on the upper bearish blue. When using this spot as a shorting opportunity, the trade is automatically cancelled if and when the RSI closes above the upper bearish blue. In this case, we took a short at 1442. 6 weeks later, the RSI closed at 63.25 at 1444, thus causing us to get stopped out, but at a meek 0.13% loss. So even with a 20x leverage, this would amount to nothing more than a 2.6% loss. And the beautiful part is that just 3 days later, the RSI again retested the upper bearish blue from below. Always from below, upon which the price rolled over and died. But there is an exception to all this. For just because the RSI closes above the upper bearish blue doesn't necessarily mean things are back to strong again. No, such outbreaks are often false ones. In early September, for example, the RSI closed at 64 despite our upper bearish blue line being set at 59. The closing price on the other hand was at 1378, but our shorting entry was at 1425. Enough time had passed between those two events, and when you are already healthily in the green, you don't want to be stopped out in vain. In such case, the stop loss is immediately triggered either at break even or if the RSI breaks the upper red line, whichever comes first. For once the RSI breaks the upper bullish red line, the dynamics have changed completely and you need to get back to the drawing board to reassess the situation. If your upper bullish red is set as 70, however, and the RSI reaches 69, it means nothing at all and your short remains in play. Now, of course, there are exceptions to these RSI techniques, lots indeed, and there are equities in which these techniques simply don't work, no matter how much data and how many market cycles we are provided with. Stocks that simply trend and do little else, Apple being a strong example, haven't really gone through the traditional market cycles and hence failed to supply us with proper RSI signals. For there simply aren't enough proper pivot levels at our disposal. Or rather, there are no real distribution phases as prices just go up and up. And whenever we get minor ones, they are neither deep nor long enough to be worth selling or shorting into before prices go bonkers again. No, for these techniques to work, the underlying equities need to be, at least to some extent, classically cyclical with accumulations followed by markups, followed by distributions, which in turn are followed by markdowns. And then you roll the rock another round. Is that even an expression? I don't know. I'm making stuff up. Don't listen to me. In this sense, you will quickly notice in which equities in which these RSI strategies work and in which they don't. Other examples when they fail to work are when the accumulation and distribution phases simply fail to offer consequent and reliable pivot levels. In such cases, there is just nothing we can do about it. And finally, we ideally need 2 previous market cycles to properly distinguish these RSI line levels. And the beautiful part is that once 2 consecutive market cycle pivot levels match, so they will in the upcoming ones too, with an uncannily high probability. I personally have yet not seen any exceptions. To quickly sum up this trilogy, naked RSI divergences are overrated, for you often have a divergence prior to prices being ready to reach new highs. But most importantly, they are discretionary, and if you cannot begin to tell the overall strength of the market without the RSI, an RSI divergence of any sort will not provide you with signals. It will provide you with confusion and noise. RSI channels let you in on the overall strength of the relevant time frame. And by properly and meticulously setting the 2 bullish red and 2 bearish blue lines, you will get early and accurate clues in several equities of when a markdown or markup are near. Prior to a markdown, for example, the 2 characteristics of such to come are first of all a steadily declining RSI from high levels around and above the upper bullish red and down below the upper bearish blue, which the RSI will also then struggle to break above. And secondly, after ideally having tested the green RSI line, the RSI then needs to make a clear touch on the upper bearish blue upon which a markdown is likely to be ready. At least such clear touches will often offer great risk to reward trades. If the RSI breaks and closes above the upper bearish blue line or above the entry price, the trade is automatically cancelled. This greatly limits the risk, which in turn offers fantastic opportunities to utilize huge leverage. I hope this extensive RSI trilogy has helped you. That was all for now. Thank you and goodbye.